As a startup founder or as an entrepreneur, it is very difficult to know when you are ready to take external investment into your company. There's a strong tendency of startup founders to start looking for money too early in their development. And who can blame them? I mean, after all, startups tend to be very short of money. I'm not talking about when you are ready to raise money. I'm talking about when your startup is sufficiently attractive to bring external financing into it. Traditionally, what happens is there's a strong tendency for companies to start raising money too early, when they're not ready, when their development of their startup is not ready. And typically, pairing that up with the way traditionally startups are evaluated in their pitches is by investors saying that pitches are good or pitches are not good. And when they're good, there's a follow-up interview and perhaps some talks, and in a successful case, there's an investment. But that doesn't make it very easy for startups to become attractive, to attract investment to them. To emphasize the tools that are coming up, and the state-of-the-art tools like lean startups or business model development or customer development, startups are more ready to become prepared for such investment readiness. There's 9 steps that startups can take in order to become much more attractive to external investors. First is do a first pass of your business model canvas. This forces you to put your ideas on paper and share them with those who might want to join you. Secondly, make sure that you demonstrate thorough and robust knowledge about the market. See if there's enough commercial research that will demonstrate that the idea is feasible. And thirdly, validate that there is indeed a customer problem to be solved out there and the possibility of your solution solving that problem. Once you complete those first 3 steps, you're most likely to be able to attract money from friends, from family, or early stage investors like government entities such as Tekes in Finland and the like. But you are not quite ready yet to take business angel money or venture capital in a general sense. There are, of course, exceptions, and these are not hard and fast rules. These are just general rules of thumb. But at that stage, you may not be ready to attract business angel investment or venture capital. The next step is come up with a low-fidelity prototype, a minimum viable product that at the lowest possible cost will demonstrate that your solution indeed does solve the problem you're setting out to solve. And it's validated with customers. Once you can validate the product market fit, your next task, which is the next step, step number 6, is you need to validate the entire right side of your business model canvas. That includes value propositions, customer segments, channels, and customer relationships, ending up with revenue streams. At that stage, you are most likely to be very attractive to early stage investors like business angels and some pre-seed or early stage venture capital investors. The next step is to come up with a high fidelity minimum viable product, an advanced prototype that builds on your insights gained from the previous 6 steps. You demonstrate that not only can it solve the problem, but it has features and functionality that has built on top of the minimum viable product that you did at a low fidelity cost. Next is validating the left side of the business model canvas. In essence, that means validating key partners, key activities, key assets, and the cost structure that is required to build your startup. Lastly is focusing on metrics that matter. And that essentially means finding metrics that are relevant to your particular business model, such as customer acquisition costs, customer retention, conversion rates, etc. Again, I'd like to emphasize that while this is not a guarantee and it's not a hard and fast rule, these are generally things that allow you to prepare to become increasingly attractive to external investors. For more information, please see the Startup Owner's Manual written by Steve Blank and Bob Dorff, where the book explores significantly in much more detail about the investment readiness level.